You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you're doing well on this Monday. I hope that you had a great weekend. Today, we're going to talk about why I never worry about the market. And that's kind of crazy because I see like a bunch of news. I can see a bunch of people talking about stagflation, talking about the market going down, like presidents going to like destroy the economy and so on. And while some people are even calling for a bear market, I mean, let's be honest, we just have like a lot of volatility, but it's not that bad. I mean, my portfolio is not even down 10% right now. But there's a reason why I never worried about the market. It's because I have conviction. I have conviction in my portfolio. And you know, confidence is when your actions are aligned with what you think, what you say, and what you do, right? So you grow confident about what you're doing because everything is aligned, so it makes sense, and therefore you don't have to think twice about whatever you're doing. Well, it's the same thing with investment. So they say when the market is down, don't touch your portfolio, right? So don't sell, don't panic sell. That's totally right. Unless you have weak spots. You know, when you have like weaknesses in your portfolio, right now, it's probably the time to take a deep look at it and solve those weaknesses because we are still in a pretty good time to do that. And even more, I mean, if you're waiting until it gets worse, if you believe it's going to get worse, well, those weak spots are just going to increase and they're going to be bigger and they're going to hurt your portfolio even more and probably put your retirement plan into jeopardy or at least force you to make some calculation. So while selling and going in cash is not an option, selling stocks to buy other stocks, selling an ETF to buy another ETF, as long as you keep the same asset allocation, that's not a problem. So the big question is, how do you identify weak spots? And this is what we're going to do today. So we're going to start easy. First things first, sector, industry, and then link between your stocks. So sectors, I go for 20% maximum per sector across all my portfolio. So if you look at like my pension plan, for example, that I report publicly, you may say, well, you're overweight in one sector or another. Well, that makes sense because it's just one portion of all my assets. So I will put all my portfolio together, use the Dividend Stocks Rock Pro portfolio to have a global view. And then if I have anything above 20%, then I'm going to start trimming. Why? Because it's a big red flag. I mean, I could tolerate 20 to 30%, but above 20, it starts to get bad. And the point is, stocks in the same sector tend to react the same way. So when you pull out your research and you use like a stock screener to select stocks, you're going, depending on when you do it, you're going to see a lot of companies in the same sector showing great numbers or very bad numbers. So for example, if you look at like 1 year growth at the end of 2021 in the oil and gas industry, like everything was double digit, even more than that, right? Not so much in 2025. If you were looking for tech stocks, for example, over the past few years, their revenue, their earnings, their dividend is just like growing super fast. But maybe it's not going to be like that forever, right? So remember tech bubble, maybe anyone? So that could hurt big time. So not being too focused on one sector is super important. Then you go into industries. So it's a subtlety, but for example, if you have like a large exposure to the financial sector, well, a mortgage crisis will not affect Visa and Brookfield the same way it will affect banks, right? So you have like multiple industries, or you can call it subsectors. It's not going to be that bad. And then it's important to understand which company, what they do. That's the whole point of like labeling stocks by sectors. Sometimes it's not that easy. Like CCL Industry, for example, is classified under materials, but it could also be classified under consumer discretionary because they're doing packaging, right? Dollarama, depending on where you look at, it could be labeled as consumer staples, which is super stable, consumer like recession resistant, sorry, or consumer discretionary because you're spending extra cash on decorations and parties items and stuff like that. So on one side or another, you can debate until tomorrow, but the point here is to know what you own and why you own it. Finally, the link between stocks. If you have Canadian Tire REIT, well, and you have Canadian Tire in your portfolio, they're kind of like intimately linked, right? Granite with Magna International, kind of same thing. You can find those companies that are interlinked or very like working hand in hand together. Qualcomm with Apple, there's a link of dependence there as well, a major one. So one is the client of the other. So you have to be a bit careful. Once you're done with this, you go into, if you're retired, you go into dividend diversification. That's another place where you can identify a weak spot. Income is important. I get that. But if you have like 10, 20, 30% of your retirement income being paid by a single company, maybe it's too much, right? Are you comfortable having this business, maybe having like a good chunk of your retirement paycheck in their hands? And what happens if they stop increasing their dividend? Well, your budget's going to suffer. If they cut, it's even worse, right? So it's really important to have a global dividend diversification so you receive income from several different sources. Finally, the most interesting part, looking into your stock portfolio, stock one by one. Focus on quality over yield. What's quality? First, metrics, right? Financial metrics. If you look at a company like BCE, for example, you see that revenue has been struggling for a while. Earnings per share has been struggling for a while. Cash flow from operations, same thing. How can this be good, right? Like you can tell yourself a story, but the numbers are telling you nothing is going right. So what is interesting here is once you have analyzed the numbers, now you can say, okay, so how BCE could actually come back from the dead and show some growth. So you can establish an investment thesis. So establishing how a company will continue to thrive. A good way to do it is that you can separate your thesis in 3 segments. The first one is the company's playbook. So how this business is making money. So for Bell, of course, they have like subscribers. They're selling like wireline, wireless services. Most of it's coming there. They have media business as well. And there you go. So that's the playbook. The growth vectors. Do we have like increase of immigration? Do we have like acquisition potential? Do we have like new projects coming on? Products, R&Ds, innovation, that could be like the growth vectors. And finally, the moat. Like what's the competitive advantages of one company versus another? Is there are like barrier to entry, strong brands, network effect, things that makes it very difficult for competitors to grab market shares, basically. So playbook, growth vectors, moat, that's going to help you shaping and writing down a solid investment thesis. I wanted to end up this show with an example with Alimentation Couche-Tard, for example. Got a pretty rough ride, right, over the past 18 months. Not the super grower that we used to know over the past few years, but when you look at the numbers, well, first, revenues are still positive. The cash flow is still increasing. The dividend as well. The only thing that is like really hurting right now, earnings per share. So kind of makes sense that the stock price is not going up right now. However, it's been a short period of time. So it's been only like about 2 years, not even. So it's kind of like different story than Bell that has been struggling for the past 5 years. So when you have those kind of numbers, you say, okay, so I'm going to wait and then it's going to take a breather. But of course, if Alimentation Couche-Tard continues to show poor earnings, poor revenue for the next 2 years, then the metrics will tell me that my investment thesis, my story is not that great. If I go with this one, while the playbook, kind of simple, convenience stores, like focus on great location, selling a bunch of stuff plus fuel, that's the playbook. The growth vectors, growth by acquisition, introducing like new products inside the convenience stores, focus on fresh products, food as well, to make it, of course, make it more convenient, increase loyalty to loyalty members, programs. Those are the growth vectors. And of course, major acquisitions like 7&I, like the 7-Eleven, that could be amazing, but not necessarily happening right now. In terms of moat, Not that much. I mean, they have like good brand recognition. They have like a good network of distribution, economies of scale, maybe, but not that far. So the playbook will be a lot about organic growth, introducing new products and focusing on food to improve margin and through acquisitions. If in the next 2 years, I don't see that being developed again because they did that several times over the years, well, then bad numbers, bad narratives, well, then it becomes a weak spot in my portfolio. It will be time to go. We're definitely not there yet. I'm not the type of person that will be happy trigger and then just go, oh my God, a trigger happy. I mean, and then say, oh, okay, so 18 months of like no growth, I'm going to sell a stock. No, I'm a patient investor. I can monitor this stocks for the next 2 years without blinking. That's not a problem. But I will still need at one point to see better numbers and a better narrative, of course. On a small note, we will be reopening Retirement Loop shortly at the end of May. Actually, we're going to have a webinar and we have like develop all the tools you need to build your retirement plan and make the ship steady. Make sure the ship is steady once you are retired. So Retirement Loop is all about building your financial projections, getting answers to your questions as you retire. You can subscribe to the waitlist right now at moosemarkets.com/retirement. So moosemarkets.com/retirement. And in a month from now, you're going to get more information, some freebies as well if you subscribe. And in a month from now, you'll be the first one in line to see what's inside Retirement Loop. It has been helping almost 500 retirees so far. So been a success, but I want to push it one step further, creating the largest Canadian retirement online community. So right, Moose, that's enough for today. Tomorrow, we're going to talk about asset allocation, Canadian versus US stocks versus international ones. That's going to be an interesting chat. So until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.